Alright guys, what's going on? This is Ryan with Blockroots, and in this video I'm going to talk about the Blockroots Alpha Trend. Okay, this is a proprietary trading strategy and signal that I've had created after thoroughly testing all of the moving averages and exponential moving average relationships, okay, things like the MACD, to try to find the best possible setup to identify changes in a trend across multiple time frames. Something that could yield the highest expectancy with the highest level of consistency, and continue to serve us well moving forward. Okay, so not just something that's perfectly curve fitted for previous price data. So I'm going to do a little bit of rambling in the beginning, then I'm going to go explain a little bit of the data that I shared, okay, and give you an idea of how you could better apply this within your own trading. So one thing first is that, yes, a large portion of this comes from a very simple concept, which is concept of an exponential moving average, or rather the application of an exponential moving average, moving averages, all these types of things that are readily available. But they are popular when they're working well, and they're not popular and they're really doubted when they're not, because Bitcoin is it's a very strong trending asset when it's in a trend, okay, but it does go through periods of sideways movement. It does go through periods of chop. And that's when you're going to find that traders who are using moving averages are going to get, like the idea entails, are going to get chopped up. So the point of using any type of system, okay, and this is why systems fail a lot of the times in crypto, is that you have to completely be systematic about your application of it. You have to be robotic. Okay, that means that every signal you take to long, okay, you take that signal. Every signal you take to sell or short, you take that signal. And you continue to apply this over a large enough sample size so that you can experience the benefit of, the positive yield that it results in, or the positive expectancy, rather, after a large enough amount of trades. Now, more often than not, when it comes to signals, okay, and this is why I was hesitant to release something that gave any type of signals, more often than not, I'm going to let you know that if you take a signal, and it works out for you, but then the next three don't, it's not the system. It's the user of the system who's suddenly acting in a discretionary manner. So signals, okay, or signal providers or strategies that are systematic like this require that you pretty much absolutely adhere to them, okay, with some exceptions, all right, in regards to if you're using this, one, to just trade robotically, or two, if you want to use this to try to maybe give you pause or reason to actually start staring at the chart and look for either the long or the short that it's saying exists. Because this is a time series momentum based strategy, okay, that means that it's going to be based on the trend and based on momentum, and Bitcoin on the lower time frame and on the higher time frame, when it begins to trend in one direction, tends to persist, okay. So there are traders that they just trade a 5-minute time frame with something like a 5-10 moving average crossover, or a 7-14 moving average crossover, or a 50-100 moving average crossover, and they stick to this though enough that even if they lose 7 out of 10 trades, they're still profitable, because for the 3 trades that they continue to apply this on and yield successful results, they more than make up for the losing trades with that high R multiple, or that high return in relation to those other losses. So this is a higher time frame view. Right now we're looking at the daily, and you could see that the long signal that was provided over here, all right, took us all the way to the top. We had a first chop period where another long signal was given, okay, another short signal. And why did these two signals occur, right? They occur because this is when we are within a range. So you have to understand what the conditions of the market are in, right? So when we're using a trending tool, it's really helpful to identify if we're in a trending market, all right? So with this tool, I would advise still mapping out support and resistance. Okay, so still mapping out support and resistance and market structure, so that we know, okay, maybe what signals might be more of an indication of chop, versus what actually might be a strong signal for either a breakout to buy or a breakdown to sell. So what I did was I compiled all of the results of, I think it was like 8 or 12 time frames for you. Okay, so go down the 2 hour. All right, we can see that we got this long signal down here so far, the last short, all right, before this major drop. But preceding it, you're going to see that there are these periods in which we're chopped up. Now remember, when we are placing a trade, regardless of the fact of the system we're using, okay, we're going to be placing a stop. So more often than not, when you're basing a system around a strategy like this, you're going to have a tight stop. Okay, if you're on the 2-hour time frame, your stop is going to be in relation to the market structure on that time frame. Okay, and yes, you will be stopped out. Okay, plenty of time. So if you're looking at a trading setup like this, what you'll see is that you're stopped out a bunch of times, but then you have one trade that more than likely makes up for the other stops. Now, the problem, and I'm just going to let you know beforehand, when you think about a strategy, okay, a lot of times in traders, or rather in newer traders' minds, they think that there's some type of golden strategy out there. Okay, no, there are strategies that have a certain hit rate and a certain expectancy, and that's it. Okay, and you need to fall within that curve. All right, meaning consider it a risk of ruin curve. All right, such that your hit rate and your expectancy have to be a minimum value for the trade system to work out in the long term. When we establish what those values are, okay, we know whether or not we could follow a system. That's it. All right. We apply proper risk management. Okay, we cut our losses quickly, and if we know that we have a system that yields positive results over 100 trades, okay, when we take losses, we understand that when we stick to our system, we are going to be in the short term likely expecting, those gains to come around the corner. So if you flip a coin that has a 50-50 chance of landing on heads or tails, there are times when you're going to get 5, 6 tails in a row, right? But you know that inevitable head's going to come up. And you might know that you also have a string of heads that are likely going to come up, and you're not going to get any tails, and things happen in clusters, all right? That's how real randomness occurs. So what I did was I made this list, okay, of all the time frames. So we have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 time frames. All right, so from the 3-minute up to the 12-hour. All right, I showed you what the long profitable amount were. So the win rate for longs, okay, what the long expectancy was. So consider the yield from a trade on average. So for each one that we risk, how much can we expect to gain? So we could see that on the 3-minute time frame, we were profitable 23% of the time. Okay, and when we were profitable, for every one that we risked, we gained 2.8. Okay, this is on the lower end of things. All right, we want to get this profitable percentage up. We want to have our expectancy at least over 2.5, at least over 3. All right, I would say the higher the better, obviously. Okay, and then I broke down the short percentage profitable for you as well. So profitable short percentage. All right, how many trades did we win that were short? All right, short expectancy. Okay. And this just breaks it down for you. So the same way that we have it set up for the longs, we have it for shorts. And then bidirectional. So this is both ways. Okay, so that just consider this as an average of the whole. So immediately your eyes go to certain places on this chart, right? So you'll see that, for example, the percentage long profitable that was the highest, okay, was the 8-hour time period. Okay, and that was also the highest expectancy. So that's a tremendous strategy right there. All right. If you have the patience to wait around for those trades and you have the enough capital to put at them, all right, you will be tremendously profitable in exercising based on that signal. Now, the implication for a trend following strategy that is skewed more towards a higher time frame is that you're going to get less opportunities that come up, but each opportunity is going to yield that much more. Okay, and then we go down to mid-tier. All right, on average, we have anywhere from the 4-hour, okay, to the 15-minute. Okay, again, over 30%, with the exception to the 30-minute. All right, and again, these expectancies are very good. So 3.8, about 3, 3.6, 3.8, 3.85. All right, these are all great, and I'm going to show you why these are great in a second, and why they are what is necessary to satisfy our requirement of a working strategy. Okay, and then at the end of this, I'm going to talk about how who most likely is going to be very discretionary, okay, even with the strategy, because you get a strategy like this, and I'm going to show you that it's proven that on all of these time frames, okay, it yields the minimum amount to make sure that you do not have a risk of ruin. Okay, maybe with the exception to the 3-minute, but we're going to tell you how you could go about still applying that with safe measures so that you don't have that risk of ruin. Because even at the risk of ruin at the 3-minute, I believe, is about 17%. So that is something you want to have down at 0, but we could still do things to trim that down at that level. But I'm not advising you to trade the 3-minute chart with this either way. So we have all of this data, right? So this is the data that is required to use a strategy, but I'm going to talk to you guys as people who largely trade in a discretionary manner. I know that you're not just going to program this into a computer and apply it at every trade. I also know that you're not going to you're more than likely not going to maintain the discipline to take every trade entry it gives you, because you're going to see a trade entry, all right, it's going to look kind of poor, or maybe maybe it looks good, but you take it and then it stops you out immediately. Okay, you get a bunch of false signals. Maybe you're during a period of chop. All right, and then maybe you're going to lose faith in it, even though you see that over about 4,000 trades, this is definitely profitable, because you're going to meddle with it. And that's where trading psychology is huge. So a lot of the times we get our hands into things and we tinker with things, and it makes us feel good to tinker with it, right? Because it gives us a feeling of control. But really what we're doing is we're actually just skewing the results, okay, against us. So all of this right now is showing us that this strategy is profitable across 12 time frames on the long and the short side, okay? With this, what you can do is you can begin to look and you'll say maybe, all right, maybe I want to try this on the 4-hour time frame because it's profitable about 40% of the time and it yields almost 4 to 1. So that is awesome, all right? And then maybe, I only want to apply on the short side of things. I only want to look at the 2-hour because it's profitable about a third of the time. And it's let's see, it's 3.3 for the expectancy. So for every one that I risk, I'm gaining 3.3. All right. Or you could look at it bidirectionally, and you could say that the best looking one here is on the 12-hour. Okay, higher time frame is going to have more meat to it, and being the Bitcoin trends heavily whenever it does on a higher time frame, that's kind of expected. All right, but then you could also look at something like the 2-hour. Okay, or you could look at the 10-minute, which although it's profitable only, let's say, a quarter of the time, every time that it's profitable, it yields about 3.5. So again, this is above the minimum requirement to make sure that we don't have a serious risk of ruin, or in this case, I don't believe any risk of ruin. It might be a fraction of a percentage, and that's where proper risk management and also adding certain targets to this can really help. Okay, to make sure we're not still stuck in a trade the way a robot would be, because the thing about a systematic trading style or an algo-driven method in which it's essentially a robot or computer trading is they're not going to pull themselves out of a trade based on discretion, or when they see the market starting to really show clear signs that really go against this strategy. So sometimes discretion, viable discretion, can be really useful. But even a strategy that only is correct a quarter of the time but yields 3.5 to 4 times on average that it loses, all right, that is what Paul Tudor Jones would talk about trying to make a trading career around. All right, if you lose 3 out of 4 times, but every time that you win a trade you win 3 times or 4 times as much as you lose, then you're still good. All right, and you're profitable in the long run. Trading is a long run game, so a lot of the times, like I said, it's short run stuff that scares us out. Okay, so this is all the meat that you need to fall back on, all right? Now, I know, though, that you're not going to be able to really just completely fall back on something like this. So that's why I'm suggesting this tool as a helpful indicator to when you should really start paying attention to one direction over the other, okay? When the trend might be shifting, especially on the higher time frames. This can give you some type of thesis, all right, rather some type of basis to establish a higher time frame thesis. So now what we're going to look at is this is the actual win ratio, okay, and payoff ratio required, okay, to satisfy that non-risk of ruin stipulation. So what you can see is that for certain win ratios, you need a minimum of return, right? So your expectancy has to be, let's say, for example, if our win ratio is 30, let's say 25%, so we only win, 25% of our trades, okay, then we need minimum, okay, a 3 to 1 reward, all right, for every one that we risk. All right, so we need a minimum of a reward of 3 for every one that we risk. Okay, and that still only puts us 51% chance of not going to that risk of ruin, right? So into losing our trading capital. So again, this is all where it's going to really matter that you take yourself out of trades that are going against you and you have stops in place. Okay, this is as if the strategy has been running, all right, without any type of target taken out or take profit or stops at all. So then we could also see that if we have a win ratio of 1 out of 4 trades that we win, if our return or expectancy is 4 and above, we have a 0% risk of ruin. Okay, so the idea that we would lose our trading capital does not exist. Okay, this is also something that is going to be applying to this right here is applying to 2% risk of trading capital, but we're going to be risking 1% of our trading capital. So I gave you that position sizing metric. Okay, that you're going to be using your stop and the percentage of your trading equity, or rather trading capital, to calculate your position size. And when your position size is below 2%, or in the case of 1% or below, okay, a lot of times you'll see that this chart completely shows that you have 0 risk of ruin. all right? And you're going to, in the future, the idea is that you're going to find what strategies and what setups, okay, what criteria, all right, satisfies the criteria or gives you the indication or might inspire you to have more confidence in certain setups to where that there's a likely return that is greater than maybe other setups. So this is not just flat applied across in that sense, because you might have trades that are outliers, the same way you could have them as losses, but you might have those trades where you are changing your position size to risk less or risk more, still being very conservative, obviously less than 2%, but there might be certain setups where you say, I'm going to actually risk a little bit less on this, and therefore your actual risk of ruin would decrease as well. So this is just essentially showing you what this chart is showing you. So I put all of this together for you right here. So right now, okay, for a strategy to be effective and have zero risk of ruin, it needs to fall above this line. So this curve right here is essentially, consider it like an equity curve, okay, in the sense that for the risk-reward ratio, it shows what is the required win rate, okay, to have no risk of reward, all right, or for it to be effective in the long term. And what we could see is we could start to look at a certain, percentage profitable and match it to the expectancy. And, we'll go to something like that 8 hour, for example. We'll look at the percentage profitable, okay, as a whole, say about 37%. So 37%, and then that puts us at 5 to 1, essentially. So that puts us all the way over here. We are far outside of this curve. Even one of the, ones that yield a little bit less, and maybe they're one of the more poor performing ones. So we'll go down to the 5-minute or the 3-minute. So bidirectional profitable percentage, okay, for the 3-minute is about 30%, 29%, so it's about right here. Okay, and then the expectancy is 3.1. So that puts us about here. It's still outside of this curve. So this is just showing you in a very metric-driven way that the strategy that you're looking at that's been tested over thousands of trades, all right, the one that we're sharing, is profitable on a large enough sample. Okay, so we're thinking for you, all right, when we talk about trying to establish a system, you need to take at least 25 trades, at least 30 trades here, okay? That number can never really be high enough, all right? You have to have a number high enough to where at some point, if something's profitable, it's going to start showing on paper, all right? And if something is not worrying, it's going to be very clear, all right? Okay, especially when we understand what our hit rate is, okay, what we're kind of seeing on average as far as the returns we're getting or the losses that we're taking, all right, and then we could begin to maybe sharpen it up or improve upon it, okay, or scrap it as a whole if it's not working. Now, what we're also going to look at right here, okay, is I'm going to show you what the chart looks like naked, okay, and I say naked because we could actually begin to improve this, as I said, for those ranging periods. So you'll see during ranging periods, this is a trade you entered, but you were stopped out, right? So you're not going to be stopped out since you're not going to be taking this as a computer would. You're not entering the trade here and then getting stopped out down here, okay? Because you're still, the best way you can apply this is to understand what the trend does first. The trend right now, okay, if we're on a 2-hour chart, the higher time frame trend is within a range. So we still are going to be mapping out our ranges. So what we would do, okay, is we'll map out these highs. Okay, we'll map out this range right here. You can see that this was an important area, important. All right, so we're still going to map out these structural areas. Okay, the lows over here, just roughly doing this right now. Okay, low, high, okay, low, low, low. All right, so this is a very important area. Okay, same as up here. Okay, this area, this area. So we'll just keep these highlighted, and we're going to continue to do this, these lows. All right, and then what we can do is when we're taking a trade based on a signal, for example, you're going to know that we are within a ranging market. So this 2-hour strategy, okay, and the 2-hour strategy, its yield is 35% on longs, okay, so a win rate of 35% on longs, and it has a long expectancy of 3.6 to 1. So when we're taking this trade, we're still doing the same thing we would do for all of our trades. We're placing a stop, okay, based on the 2-hour time frame. All right, we're placing a stop, and it's going to be probably a pretty tight stop because we're within a range, all right? And then what are we also going to understand, though? This long entry might not be the best one to take because we are at market structure right here based on a support and resistance zone that has been important throughout the previous, or rather throughout the structure that has occurred previous to where we currently are. So you might see these long setups, okay? And this will give you an indication of the trend is sort of changing, but we still haven't broke out of this range, all right? We still have not broke out of this range, or maybe you see this long setup here, and that's the first touch of this. Okay, I sort of over here have that, but not so much. First rejection over here. Now you have this over here, short, again, fail, right? So we see it's still chop. Okay, so stopped out immediately. All right, but now you see a long setup here, and now you know that this is the second time that this resistance is tested, so you have a little bit more basis for the potential of this breaking. All right, so what I'm trying to give you is some insight into how you can actually apply this when you're in a ranging market, because this is how a machine learning strategy might go about applying this. All right, so remember though that the lower time frames are going to yield more chop, okay, especially during ranging markets. All right, especially during ranging markets. Now the other way that we could really sharpen this out, okay, is when you're taking trades, all right, you might not, a trade might be starting to go against you, all right, it might be in profit, but it might be worth actually pulling yourself out of the trade, okay, if we're trying to trade a trending-based strategy, but we see the market isn't really showing us too much of a trend. So what we can do is we could actually, again, use the Heikin-Ashi candles. So if I put on the Heikin-Ashi candles, all right, for some of these trades, if we go back to where we were over here, I can see that when I'm given this long signal, okay, the first thing that I see are these candles that are showing to me that a trend is not up. So we know where the Heikin-Ashi candles work. They're calculated differently. All right, what we can see is we're given a long signal, but we immediately see weakness. All right, so with Heikin-Ashi, what we can look for is we have, say, for example, over here, right? So we have this structure over here, okay, market structure rejected. This was the area where we saw a major divergence in the CVD. Okay, I mentioned this how we previously, before we broke down, I mentioned that that was setting up. Okay, you're given a short signal. All right, your stop is likely going to be right above market structure. You're not stopped out of this trade yet. Okay, that's great. You could set something such as, if a trade is moving in my favor, all right, I want to see a minimum of, let's say, 4 Heikin-Ashi candles going against me, all right, before I maybe voluntarily pull myself out of the trade. All right, so this can potentially sharpen up the actual way that you're going to go about possibly applying this in a discretionary manner. You can see over here, you're given a long signal, okay, and this will save you from some of the potential chop, right? So you're given a long signal over here, okay, you see the trend going against you immediately, all right, at resistance, okay? Same thing over here, we're coming at resistance, all right, you might be in the long already, okay, at this point, your percentage profitable, you might have just pulled a few percent off the table. If we just look at it from here, all right, you're at resistance. This might be a good time to take some off the table. So you could take these signals and take them from a structure to structure standpoint, or from take it from a structure to a structure. So when you're within the ranging market, I would say to still draw your market structure so that when you get a signal, say for example, we get the signal down here to long, okay, this is a trending based signal, okay, we are in a range. So the possibility that the range comes back against us within a trend is always there. So at least when we have market structure drawn, so this resistance right here, or this resistance up here that you can see, this might be a good area for you to take profits rather than waiting for what is given as a long signal and then a short signal to sell. So I would use this as a potential setup to take a trade entry, but always keep in mind what the overall picture looks like, and because of that, consider taking an exit based on a more discretionary approach, all right? Especially on the lower time frames. Because what I'm showing you is that this is profitable on the lower time frames, okay? On the lower time frames, it is profitable, all right? But that when you are taking this, okay, as a human being, if you're taking this based on just inputs and outputs, all right, so feedback you're entering in a trade here, you get stopped out here, you're entering a trade here, you get stopped out here, you enter in a trade here, you get stopped out here, where you're not pulling yourself out of the trade based on this actual interaction with structure. If you're just taking this naked, okay, then you might get frustrated, all right? You might see this band of trades right here and think, what the hell? This is a profitable strategy. Why is this not yielding profitable results right now? That's the thing. This is right now. This is from a period of the 16th, okay, to the 28th. Small drop of water in a big bucket. So this is the case where you might want to really pay more attention to the actual range you're within. And you could still begin to use this as a scalping tool then at that point, where you can take a trade entry either to long or short based on where we are in proximity to market structure. And then lastly, using the Heikin-Ashi candles can really confirm the trend, all right, especially when, say, for example, you get that long signal over here and we have the HA candles on. Okay, what we can see is that based on the color of the HA candles or Heikin Ashi, it's computed by a different, completely different high-low calculation that the trend is strong. All right, that some of these candles, while they might be selling candles on the way up, the trend is still showing strong. What we might want to do is pull ourselves out of maybe successive Heikin Ashi candles in the opposite direction. Okay, so this can just help us better apply this strategy during chop. All right. Still, we place our stop. So you're given the long signal over here, and this is, remember, we're just using the 2-hour time frame for reference right now. We go on to the 4-hour time frame, all right, and things, again, they change. So the most recently, short over here, okay, came down here, but it started reversing, all right, and we were stopped up here. Instead of taking the trade, where you're short over here, okay, and you're stopped out right there, you can begin to apply this from the approach of taking profit where you have something like market structure hit, right? So if we see that we are, for example, in a period where we have a short setup, okay, price comes back up, we have a stop over here, okay, still above the structure, we're not given any kind of long setup, all right, then this is again one of those potential larger moves that is starting to play out. As you can see, the Heikin Ashi candle is confirming it as well. All right, again, this is just a way to potentially sharpen this strategy, being that you're going to be applying it as a discretionary trader. All right, so from a market structure standpoint, we still have to. Now, this is for most recently. Now, once we're in a trending market again, okay, you could begin to apply this, you know, in a much more liberal way. So what I mean is, when we break this high, okay, if we break this high, or say, for example, we retest here and fail, or we fail from here. All right, the trend in that case is going to be a bit more clear. All right, I still have to say that we have to keep in mind that still the higher time frame trend is up, so we're all expecting this to rebound at some point. So this is the trend that I consider most important. Okay, that you're longing the long more than anything else. You're not longing the short more than anything else. That might sound confusing, but what I mean is I still think that any short in this market has a shorter lifespan than any long. Right, so. Right now, we're within the ranging market. So right now, it is still really important to draw those key structural areas, all right, to look for potential exits when using this strategy. But this is the meat and potatoes, right? This is the data of this entire strategy. Okay, this entire thing is profitable, all right? Using the Heikin Ashi candles can really substantiate any type of use for this, or rather the case for use, the case for exit, or continuing to stay in, all right, because there are, and I'm only saying this because you're not supposed to do this, but I know that as discretionary traders, one thing that you want is you want to find the golden strategy. It doesn't exist, okay? There are basically two types of strategies. There are trend following strategies, and then there are mean reversion strategies, okay? Breakout, I'll say, trend following, mean reversion, okay? You have certain algos that are mean reverting. Okay, so when price drops a certain percentage, you'll see them step in because they're looking for price to correct a little bit. Same can be said for moves to the upside. When an increase in volatility occurs, price moves up. You'll have mean reverting strategies look to take advantage of that pullback. Okay, those are going to be automatic. You'll have automatic trend following strategies, and then you'll have breakout strategies. You're not going to take these like a robot would. Okay, I know that you're not going to take them like a robot would. So what I'm doing is I'm telling you how you could potentially maybe settle some of your fears, or instill a little bit more confidence when you're taking one of these setups. What I would say is, if you're trading a certain way right now, use this type of signal to act as some type of confirmation into potentially what you are already seeing, okay? Unless it stands out as glaring opposition, okay, use this to potentially indicate to you, maybe I would say first on the higher time frame, so from the 4-hour up, okay, what the potential direction is to pay attention to, all right? So we were biased towards short from here, okay, and we broke down through market structure, so this is a really valuable entry, and it has been, so we know that this trend is intact, okay. Right now, it has changed. We are flipping to the upside. Again, you could trade you want to trade in the direction of the trend, but you also have to be mindful of what the higher time frame trend is. And the higher time frame trend, okay, is the last trend, and that is still down, all right. So hopefully this has been helpful, guys. The most important thing to understand, okay, and you're going to have to move towards this if your goal is to survive in the long run, is that this is a systematic strategy, okay? Any of the strategies that you see shared on Twitter are going to be the exact same way, okay? They're going to look great on one chart setting, okay? They're going to have I hope they would have this type of data. I don't know if, I feel like most people have not gone so far to compile most of this, and they're going to look attractive on one setting, but on a high enough, large enough time frame throughout a large enough sample of trades, they're likely not going to be positive across the board. Now, what we can see is that I've done this homework. All right, so strategy tester will go through the time frames. Look, this will show us how many trades based on how many on the time frame. Again, 39% profitable. Okay, 38, 15 minute, 39. This is with the Heikin-Ashi candles. This is a little bit different because there's less candles. Okay, but what we can see, the data backs this up. List of trades, all right, based on a theoretical amount. Okay, this shows there are plenty of losses, right? But these are the list of trades, right? Then there are those big wins. All right, performance summary, Sharpe ratio, all right, number of losing trades, number of winning trades, okay, percentage profitable, 65%, all right, the win average, loss average, 5.8, all right, so that is your expectancy, okay. So this is all of the data that is required to substantiate a case for a strategy being effective or not effective, okay, and we could see that this is effective across the board. So right now I would say use this as a tool to pay attention. So when a signal is given on a higher time frame, I would start with that. And then what you can begin to do is really start to create your own little niche and really start to develop your own area within the market. That might be on the lower time frame or the higher time frame, but then that's where this would really potentially benefit any type of strategy, whether it's to add a second clue, okay, add a little bit of alpha, all right, in terms of identifying maybe which trend the short term or the higher time frame direction is in, or rather what the trend is. And then if you're able to take this second outside of your, let's say you create a second strategy to your own discretionary strategy and you say, I'm going to allocate money just to this, all right, and I'm not going to, I'm only going to follow this. If you only followed this, you would be profitable, all right. Now, sometimes things change, and I will continue to keep rigorous records of this. All right, if anything crazy changes to the market, I doubt it will. But we have to imagine sometimes edges erode. All right, so if anything changes, we will make updates to this. But right now, if you were to take 1,000 trades based on this, all right, it would be profitable across all of those time frames. All right, but you'd have to stick to it like a robot. And that's why I've given you these other ways in which you could sharpen this for your own discretionary use. So hopefully that has been helpful, guys. This is Ryan with Blockroots. As always, exercise proper risk management and trade effectively.